it's great to be having some warm, sunny days, and I think we can apply that as a metaphor to the Scottish economy, because we're seeing very good economic numbers in the last few quarters. Particularly, we see output growing quite strongly in the UK as a whole. In Scotland, output growth was weaker, but this is largely illusory because we had the Grangemouth dispute at the end of last year, and that took away, surprisingly, quite a bit of the growth, about 0.2 to 0.4%. So if we sort of factor that back in, we see Scotland growing round about the same as the UK economy in the final quarter of last year at an annual rate of round about 2.5 to 3%, which is above trend and quite strong. The labour market also is doing exceptionally well. At the UK level, we see thousands, hundreds of thousands of jobs being created, in fact 345,000 in the quarter up to March. And that is a phenomenally large growth rate. We see large numbers of jobs being created in Scotland. So overall, the picture here is one of a strong recovery, output rising, jobs being created, unemployment falling. It's now at 6.6%, although that's still quite a way from where we were at the peak of the boom before the recession, when unemployment was about 3.9%. So this is all good news, and on this basis we are forecasting some positive numbers for the Scottish economy over the next 3 years. However, as usual, there is a but, and the but here is that there are still significant risks that the economy has to navigate before we can be certain that we have a sustained recovery. And I think we've mentioned this before. One of the issues that is confronting us is the extent to which growth is unbalanced, and it's been largely still driven by household spending. We see some recovery in the investment position, which is good news, and we hope and expect that to strengthen. But in terms of how we're doing on the export front, we're still importing much more than we are exporting, and that's providing a dampening effect on growth. When we look at household spending, it's still hard to accept that this strong growth in household spending, we must ask, where is it coming from? Because by and large, when you look at the growth of real wages in the UK as a whole, this has been negative for quite a period of time, and that has been the case in Scotland, although there does seem to be some evidence in the last year that real wages have started to rise. So household spending is actually being fueled by borrowing. And of course, the problem with borrowing is that you have to pay it back, and you have to pay it back at a rate of interest. And this is why we are concerned about the housing market in the UK economy, because housing prices in London are rocketing away. They're going at 19% at the moment. UK house prices are rising by about 10%. And now we've just seen that Scottish prices are rising just under 5%. Still a big gap there. But this growth in house prices is something to be concerned about, because it's quite clear that to the extent that we expect the Bank of England to raise interest rates, it's been driven by the housing market, to a certain extent by the recovery, but it's not driven by inflation, because the inflation rate is way below target at 1.5%, and core inflation, which is largely earnings, is growing by about 0.8%, so way below the 2%. So there's a lot of pressure on the Bank of England to raise interest rates, and a lot of that is driven by the housing market and the house price boom in London. We say don't go there, hold back on interest rate rises, because if you start to introduce interest rates soon and you do it too quickly, this will dampen house price growth. It will impinge and penalise those households who are having to pay significant mortgages. And what we're likely to see is a collapse in household spending, and that will plunge us back into either slow growth and, a worst case scenario, a recession. So we don't want the Bank of England to go there. We expect interest rates will start to rise a little next year. They will rise slowly. But we want the bank to focus on the housing market by what they call macroprudential policy, which is trying to encourage loan to house value ratios to be lower than they have been recently, and loan to income ratios also to be lower. If they can do that, if they can manage the booming in house prices, then that will help the economy sustain itself. We also have this issue too that while investment is picking up, clearly in the end, it depends on having plant and machinery in place to produce goods and services for customers. And if the customers are not there, then the investment will start to tail off. We've seen that the demand has been stimulated in Britain by household demand. But of course, exports are very important. Exports are weak at the moment, and that's partly driven by weakness in our key markets. And one of those markets is the Eurozone. And the picture in the Eurozone isn't good. We see that prices are almost falling there. The European Central Bank has cut interest rates again, maybe about to stimulate demand through trying to expand the money supply. But that's quite worrying, because if there is deflation in the Eurozone, that will effectively dampen the demand for our exports and be another burden on our recovery. So against this background, we're still very bullish about where the economy is going. We expect growth of 2.5% this year. Next year, we're a bit more cautious. We're cutting it back to 2.2% from our March forecast of 2.3%. And we're forecasting GDP in 2016 to grow by 2.4%. But our outlier is that, given these risks, if some of these start to come in, then growth would probably be no more than 1% in 2016. But that's something that we hope will not happen, that wiser councils will prevail, and that growth will be sustained. Jobs have been created. We expect about 45,000 in each of the next couple of years, rising to nearly 60,000 in 2016. And that will help unemployment fall further from its current 6.6% to probably just below 6%, 5.5% by the end of 2016. So this is a very positive picture overall, but behind this is the risk that the economy may run up against a drop in consumer demand through household spending be cut back, and that would be principally triggered by rising interest rates. So our message to the Bank of England is, please don't go there.